Advanced Financial Accounting Excel Practice Problem. In this presentation, we're going to work a consolidation problem in Excel where we have a parent-subsidiary relationship. We're going to be consolidating the financial statements together. We're going to say that there's a wholly owned subsidiary, so the parent owns 100% of the subsidiary. As part of this problem, we will have a difference between the fair market value of the property, plant, and equipment at the point of purchase and the book value. We'll also have the intercompany transactions, some intercompany transactions that we will have to eliminate during the consolidation process. And we're going to be working the consolidation basically 5 years later. So in other words, we're going to say that the purchase took place in January of, say, year 1. Now it's year 5, December year 5. We're doing a consolidation at that point in time. Get ready to account with Advanced Financial Accounting. Here we are in our Excel worksheet. We got the information on the left. We're going to be entering that into the blue area down below and to the right. We're going to be putting together our acceleration worksheet where we have the trial balance for P and for S. Then we'll be entering our elimination or consolidation entries, whichever you'd like to call them. We're going to go back to the left. Let's take a look at our data. We're saying P purchases 100% of S, P parent, S subsidiary. As of the beginning year, we're going to say 2000 x5. Now we're going to be doing this consolidation basically 5 years later. So then it's been a few years since the point in time of the consolidation transaction or the purchase transaction. And and remember that as we do some of these consolidation entries, they're not things that we're entering into the books. So we're going to have to basically, kind of redo these consolidation journal entries each time and consider what is happening as we move forward since the point of the initial purchase that resulted in the consolidation process taking place. So then we have the fair value of the PP&E was higher than book value by $56,000. So if we look at S over here, now remember that S here is representing the subsidiary 5 years later. But if we looked at it, the trial balance at the point in time of the purchase, we're saying that the property, plant, and equipment down here, we're going to say the building and machinery, the depreciable assets, was higher by the $56,000. So we're going to have to deal with that. And note that that being the case, and that is often the case, there's going to be a difference or a change in something like the building and equipment. We'll also have a problem for us with regards to the depreciation that will result in future periods since that point in time as well, because we're going to have to basically account for that difference for a fair market value at the point in time of the transaction, and then the related accumulated depreciation. To do that, we're going to say the accumulated depreciation was, well, not to do that, but the accumulated depreciation was $10,000 at the point in time of the purchase. And then to help us with that depreciation method, we will be saying it's 10-year property. So we'll see how to deal with that accumulated depreciation. Then we have the intercompany receivables of $13,000. So there's a transaction receivable on one book and a payable on the other books for $13,000. We will have to eliminate. And then we have the equity at the point of purchase. So at the point of purchase, the equity in S, in other words, if I looked at just the equity section in the balance sheet at the point of purchase for S, that's where we would that is where we would typically go in real life. We would see then that the retained earnings was $56,000, the common stock $103,000. So the 103, of course, has not changed. The retained earnings has changed because it's been a few years now. We're not talking about the point right after the time that we had the purchase. We're not even talking the next year. Now we're talking a few years out. So that is that. And then we're going to say that the combination as of 2019. So again, we're doing this as of basically 2019, in essence, 5 years. So you got 2000 x5 because it was the beginning of that year, x6, x7, 8, 9. So we're talking 5 years here. Okay, so let's go through and think about our calculation down below for the goodwill that we would typically calculate. So if we're going to say, all right, if the book value is, let's do the sum formula, let's say, equals the sum of these items. Now that would be the book value because, of course, assets minus liabilities equals the equity section. So the equity section, that's why a book problem would have to give us this equity section, which in practice we will typically get from the balance sheet, right? So we're going to say the equity section of the balance sheet at the point in time that the consolidation originally happened due to the purchase was that's the book value that represents assets minus the liabilities. Then we're going to convert this to the fair value by saying there was some of the assets that we had to revalue, those being the property, plant, and equipment, which we're saying 56,000 higher. So PP&E 56,000 higher. Therefore, fair value at the point in time that the purchase took place will be the sum of those two, adding them up. That gives us the 215,000. How much did we pay? How much did P pay for the shares? 215,000. Therefore, no goodwill is involved here. We still have an issue that we'll have to be dealing with, that being the property, plant, and equipment being different. So we're going to have to deal with that in the consolidation, but we don't have to worry about the goodwill. In this case, we're going to be concentrating in on here and the problems that result from it, given the fact that it's like 5 years out now, and we're going to have to deal with the depreciation on it as well. All right, so let's go back on over to our worksheet. We can then sum these guys up if we want to do that, which we do, because that's part of the process. So we've got P's books, we've got S's books. We're going to be summing these up to get our consolidation worksheet over here. So we're just going to hit the equals the SUM, our standard type of formula, summing those up, and then I'm going to go ahead and Control C and copy that, holding down the Shift, and then I'm scrolling down with the arrows. I'm going to use more keystrokes here because that's more nerdy, which is of course objective and something we're striving for. So we have that. Then if we take a look at this investment account there, we're going to eliminate that in our elimination entries as we've seen in prior problems. How are we going to, now the question is, how did that get there? We can't see it from the point in time that the company this account started, because we're in year 5 now. So, but what we can do is think about, all right, what transactions took place with this investment account in this year, basically 5 years out, 5 years after the initial purchase. Note that when you're dealing with something that has a change to the machinery and equipment or depreciable assets, you want to be considering how the equity method is being applied. Why? Because the machinery and building of depreciable assets is going to have an effect on the income statement with depreciation that's not being recorded by S, but once consolidated, you would think that it would be part of the consolidation process. So in other words, when you think about the equity method and the recording of basically the net income for the equity method on P's books for S's net income, because P owns 100% of S, are they taking into consideration the change as a result of the difference in the property, plant, and equipment when they record that equity method? Now, I've seen problems that have taken that into consideration and some that don't. And as you see the data, you want to be considering, okay, how is this calculation, how is this number being calculated? So this is what I mean by this. Notice that this number down here is the net income of S based on their book value information, right? Which we're going to change with regards to the consolidation, with regards to the property, plant, and equipment depreciable assets, due to it being different at the point in time of the purchase. But if I look at this 33,600 and what was recorded on P's books, P being a fully 100% owner, you would think that this number in income from S would be the same as this number, the 33,600. It would, typically. However, P may be saying, hey, look, I'm going to take into consideration at this point in time, recognizing the proportion of income over here based on, and taking into consideration the depreciation that we're going to have to be accounting for once we consolidate. So instead of just taking this 33,600, P is saying, hey, look, I'm going to adjust that amount for the excess depreciation expense based on the fact that when the consolidation took place, the property, plants, and equipment was higher. So what would that look like? Well, this is going to be where our new calculation comes in. We're going to say if this is going to be equal to, I'm just going to do a quick calculation so we can see what I'm talking about here. We said the property, plant, and equipment was $56,000 higher. And then if we depreciate that at just a flat 10% a year, which is a simplified thing to do because we'd really have to know each piece of equipment and do that and figure out what the depreciation would be, but you can get the idea. Now we're going to say there's 56,000 divided by 10 depreciation expense that will be added per year to that 33,600. And that's the difference, right? So if I take that 33,600 and account for the added depreciation involved here, then we would have the 28,000 for the net income, which is what P recorded. So that means that P took into consideration the added depreciation when recording the equity method. So you can think about that in terms of journal entries. So you could say, well, maybe I'll think about it in terms of this way. I'll say, well, the investment went on the books for the equity method. We could say that they took into consideration all of the $33,600 normal equity method, and then that decreased the income from S. Decreased that increased the income from S, this number. But then they adjusted for it again down here, and they said, now I'm going to account for that depreciation, basically. Decreasing the income from S, which would be netting these two out, down to the $28,000, the other side going into the investment. So that's they could do it in a net process, or you could just see one journal entry that would basically be taken on this $28,000 rather than the $33,600. Then, of course, we have the normal, the dividends, where cash dividends were paid by S to P. P owns 100% of S, therefore the full $13,000 here, and the credit of the investment of the $13,000. So these are the transactions that are affecting the investment in S on P's books in the current year that we are working on. Now, of course, this $41,000 doesn't tie out to the amount up top here, because it's year 5 right now, and there's been activity since using the equity method since the point of the purchase that took place 5 years ago. All right, now let's think about our adjusting journal entries. I'm going to try to break these out in some more components again. You might want to think about this as one long journal entry. Some people, I think that'll be easier to think about, or you might want to try to break them out into their components. Either way has their pros and cons. Let's try to break them out into component parts this time. So first off, I know that this investment's going to go off the books. But again, I'm going to use that as, instead of taking the full amount off now, I'm going to use that basically as the plug account, and then I'm gonna think about the equity section, basically income accounts that we need to remove first. All right, so then I'm going to go back up top and say that we know we need to remove the common stock. So the common stock here needs to be removed for S. So I'm going to take away that whole 103. It's a credit here, so I'm going to debit it up top. So I'm going to say negative of that number. And then we're going to take the retained earnings. So retained earnings for S is going to be removed. So I'm going to go on over to the retained earnings amount so that we can remove that for S as well. So I'm going to say negative of that 93. And then the dividends. Dividends need to be removed. So I'm going to go on down to those dividends so that we can remove them. And that's a debit over here. So we're going to do the opposite to them, which will be the credit. So we're on the credit side, removing those dividends. Now we're also going to be removing basically the income here. Now the income was for the $33,600, right? That's the entire amount. But we're not going to remove the $33,600. We're going to remove the one line item on P's books that would typically represent it, that being the $28,000. However, again, I'm going to represent the full $33,600 here, and then we'll show this difference, this $5,600 difference, in another journal entry. So when I do this, then it's not going to be removing this, or it's not going to take this down to 0. It's going to take it past 0, and then we'll account for the difference in another component. Why would I do it that way? Because this journal entry is basically looking at removing the equity kind of accounts, right? Which means we removed these accounts right here, and we kind of removed these accounts, this $33,600, but we did so by removing this one in the retained earnings or income statement as part of equity. So I'm not going to use this 28. I'm going to use the $33,600. All right, so then I'm going to go back up top. We're going to say that this is going to be equal to, we're going to be picking up the income from S. I'm not going to be picking up the 28. However, we're going to be picking up as a debit the full net income, that being the $33,600. So the $33,600, and then I'm just going to use the plug up top. So we've removed kind of like the equity section type of transactions. I'm going to put the plug as the negative sum. This is our plug formula, whatever we need to do to be in balance. There we have that. Now, let's post this out and see what we have thus far. Here's the investment in S. I'm going to scroll on over to the investment in S over here. So I'm going to say equals and scroll on back up, and we're at the 216.6. Now, this doesn't go down to 0 yet, right? We still got things that we need to account for there, so we'll keep working on that. Then we're going to record the common stock. Scrolling back over to the common stock. equals, and we're going to be pulling up that 103,000, the 103,000. So here is P, here's S's portion, there's the total minus S's portion, it gives us back to P's portion. Retained earnings, let's do the same thing for retained earnings, because it was fun with common stock, so it'll be more fun doing it to another one here. So retained earnings, so we have, this is P's, this is S, there's the total, we remove then S, bringing us back to P. Let's go on down to the dividends. The dividends for that 13,000, there they are. So we have the dividends for P, for S, the total, then we remove the dividends for S, bringing us back on over to P. Then we're going to go down to the income. So now we're on L, 16 equals, we're going to be taking out this income. It's going to look funny because you would think it would be 28,000, but it's not. And we're going to be left with that 5,600 because that's we're trying to think about removing all of the equity. And so we're left with that 5,600, which of course deals kind of like with that retained earnings that we'll have to deal with in another journal entry. Okay, so now let's think about the journal entry that would deal with that 5,600. So, and that's going to be the depreciation in the current year. Now, you could think about this in a couple different ways. You could think about the normal type of depreciation journal entry, which means you would debit depreciation expense and credit accumulated depreciation. But we're going to think about it in kind of two components here. So, and we'll do this slightly differently in the next problem we go over. So, let's think about this. We're going to say, all right, then we have depreciation expense that we're going to have to record for that added amount of property, plants, and equipment or depreciable assets that we did not put on, that weren't on the books of S, that we had to increase due to the fair value. We're going to calculate the depreciation, you'll recall, being that we had this amount, the 56,000 divided by 10 years, straight line depreciation. That's a simplified calculation, of course. So it might be more complicated to figure out which types of depreciation, have a depreciation schedule and whatnot to track this difference and how to properly account for the depreciation, but you get the idea for it. And then instead of recording the other side right now to accumulated depreciation, we're going to do that later. We're going to record the other side to get rid of this number. So that number right there, we're going to say, let's remove that now. So I'm going to say, and because that needs to go to 0 as we know. So I'm going to say, let's remove that. And there we have it. So now if we record this out, depreciation will go up for the current year. That would make sense because this is 1 year and we'd have the depreciation for it that would need to be added for that added amount of the depreciable property. The other side then zeroing out this income from S, which takes us to where we would expect it to be at 0. So I'm going to say F2 plus F2. And there we remove that item. So then this goes to 0. That makes sense. And we have the depreciation now being recorded, added to, and that makes sense. So now we have the depreciation for the current period recorded, but note it's also been 5 years since the point in time that this happened, and we put this thing on the books now. Now we're saying, hey, look, this building and machinery is higher, is increased in terms of value that we're going to have to basically account for. So we need to account for the increase in here and the related accumulated depreciation that has taken place since that point in time. So let's think about that. We're going to go, all right, well now we know that I'm going to say equals the building and machinery. That needs to be going up by the amount that we said it was higher by at the point in time that we made the actual transaction or the sale took place. It was $56,000 higher. But that was 5 years ago. And so we're also going to have to deal with the accumulated depreciation resulting from that. So we're going to say there's been accumulated depreciation that we've been recording on that, just like we did down here for basically 5 years now. Now, we've already recorded the current year here, so now I'm going to record the accumulated depreciation side of things, which basically means we did straight line depreciation, and we have 5 years, right? It's 2000x5 to 2000x9, so including year 5, 6, 7, 8, 9, I'm counting on my fingers, that's 5 years. Okay, so now we're going to then say then that we have this equals the 56,000 divided by 10. Something happened. Hold on a second. This equals, starting over, let's put a bracket around it. Let's put brackets. 56,000 divided by 10. I shouldn't need brackets. It's a division problem. And then I'm going to say times 5. All right. So there's going to be that, right? And that's just basically taking that 5,600 1-year depreciation times 5 to record the accumulated depreciation on the year. And that should actually be a credit over here because it's accumulated depreciation. Control X, cut, paste. Then I'm going to say Control C for the blue. And then I need to make it a negative, so I'm going to double click on it. I'm going to put a negative in front of this brackets. And there we have that. So there's the 28,000. Now the difference then is going to be included. That's going to be part of this investment area item here. So that's going to be part of this investment item, and you'll see that that's what we have left, that 28,000. So 28,000. So this should be 28,000. This is the plug formula, negative sum plug formula of these items. And there we have that. All right, let's record this one. So we're going to say now the building and the machinery is going to be increased by the 56,000 fair value at the point in time over the book value at the point in time of purchase. The accumulated depreciation then being here in L8 equals, and that's going to be the 28,000. And then we have the investment in S. Investment in S. That's going to be here. I'm going to say F2 plus F2, and then scroll down to the 28. And that should take this down to 0. So this makes sense now. So that goes down to 0. We've now increased the accumulated depreciation by the 5 years of the added value that we had to accumulate. So that's where that falls into play. And the difference then being included in the investment in S, because it's been, accounted for as we've been using the equity method for the investment account, finally bringing this down to 0, which is what we've been hoping to do for some time. Those are going to be the harder kind of journal entries. We'll do that a little bit different format in a future problem. Again, you might make it easy. It might be easier to see this all as one journal entry, where you'd basically just record this amount, for the total amount, and then kind of work all these things out in one long journal entry. It might be easier to see in that way, but at the same time, it might be easier to break it out. So now let's think about the intercompany transaction. So we had an intercompany transaction here where one company sold something to another company. In other words, there's a receivable on the books from S, and there's a payable on the books from P. How would we know that? Because if we look at if we looked at P's subsidiary ledger by customer, we'd see one of the customers that owe them money is S. And if we look at the subsidiary ledger for S for accounts payable, we would see that P is on it, and they should be equal and opposite. So we should be able to simply remove this. Now remember, this type of transaction, once it's on the balance sheet, you could think, okay, well, they tie out, if there's a receivable and a payable, then they should just basically net out, but we want to remove them so that, in other words, they'll net out. The equity section will remain the same, but we want to remove the intercompany transaction. So we're going to say then the payable needs to go down with a debit, and we're going to say that the receivable is going to go down with a credit. And we said that the amount was 4. We're going to say the intercompany receivable was that 13,000. So we'll pick up that 13,000 debit and credit. There we have that. Now let's remove that. So I'm going to go to the payable in our worksheet. So here we are in L10 equals, and we're going to pick up that 13,000. So we'll pick up that 13,000, enter. There we have that. Now let's go to the receivable side of things. Up top in the receivable equals, scrolling down to the credit now of the 13,000, decreasing the receivable. So there we have that. One last thing, and that's going to be that we still need to, just as we've seen in our prior problems, net out the accumulated depreciation as it was at the point of purchase 5 years ago with the book value. So we're basically starting at the book value, kind of like there was a purchase taking place when we do the consolidation at the point of time that the purchase took place 5 years ago in our problem here. Therefore, we're going to be debiting the accumulated depreciation, and we're going to be crediting the building and machinery. Now, in practice, of course, we would get this information from the point in time when we, 5 years ago, when we had the first purchase took place. The book problem's going to have to give it to you here. We can't do any kind of tricky method as we could if it was only 1 year out. So they're going to have to give us what the depreciation was at that time, which in our case was 10,000. So we're going to say 10,000. That's what it was. So there we have that. And then we'll just do this final transaction, which is going to be a debit to accumulated depreciation. So we'll go on up to the accumulated depreciation. So we could debit it. We're in we are in we're in L8. I'm going to say F2 plus F2. And then a lot of letters got confused there. There's that 10,000. Then we're going to be up in the building. We're recording the other side. Something's in it again. So I'm going to say F2 plus F2. Scrolling back on down to that building and machinery. And there we have that. That should put us back in balance. And there is the end result. So if we just kind of go through this little, we remove the intercompany transaction. Machinery and equipment has been adjusted for the fact that we had the fair value adjustment, and also for the fact that we adjusted the beginning balance. So these little items up here are useful to use, and those are in the data over here, and then actually they're in formulas, and then these are the tools. So then you can say, okay, what is that made of? It's made up of those two, right? And then we had the depreciation being recorded for basically these items, the 5 years of depreciation plus that adjustment for the first year. We have the investment in S that we took out in a step-by-step type of fashion. So we could see that being affected in these transactions. And then we removed the intercompany here. We removed basically S's equity section. And then we had the income from S, which again we did with breaking out in two component parts to pick that one up. And then, of course, the depreciation recorded here, adding to the depreciation for the current year's depreciation component for the increase in the book value at the point in time that the purchase took place.